Good afternoon. Let's do some business. We are doing it live right here, doing more at 4 weekday afternoons. We get right down to business with the news-driven hour right after Ben Shapiro's show, and all this just before the 790 KBC News Blitz with Randy Wang at 5. Mottek On Money, live on the air on 790 KBC, streaming live online worldwide at kbc.com, and your on-demand Mottek On Money podcast, kbc.com, Apple, iTunes, and all of your favorite podcast platforms. Stocks ending the day lower today, but off the session lows. Nervous day today as traders monitor the latest developments in the Middle East. Also, we're awaiting that monthly jobs report, the big enchilada of monthly economic reports. It'll be coming out first thing tomorrow morning. Inflation concerns have also reignited with higher oil prices today. And also the Fed now arguably not doing enough to address building price pressures. We do have some breaking news on the port strike back east and along the Gulf Coast. As you might have just heard, the AP is reporting the union for 45,000 U.S. dock workers have agreed to suspend the strike until January 15th to provide time to negotiate a new contract. That's the very latest. According to the Associated Press, quoting their sources, port work could resume as soon as this evening back east. We'll discuss the very latest breaking news with Peter Tershwell. Peter Tershwell with the Authoritative Journal of Commerce. He's the Vice President, Maritime Trade and Supply Chain Division there, which provides a range of analytics in that field. He's also responsible for all the content appearing in the Journal of Commerce publications, websites, and events, including the Trans-Pacific Maritime Conference, which is held annually in Long Beach. Peter Tershwell will be giving us the very latest news on all this later this hour. The stock market pulling back today with the Dow down nearly 200 points, the S&P 500 down just about 10, and the Nasdaq lost just about 7 points. Tensions running high in the Middle East as the Jewish New Year holiday Rosh Hashanah begins and the one-year anniversary of the terror attack on Israel by Hamas approaches on October 7th. Rise in oil prices intensified today after President Biden suggested that the U.S. is considering whether to support an Israeli strike on Iranian oil facilities, a move that could push gas prices higher just weeks before the presidential election. Price of crude oil in New York popped today, up more than 5% to $73.71 a barrel, its largest one-day gain since the early stages of Israel's war on Hamas a year ago, following the terror attack by Hamas on Israel. And also, we're watching Brent crude in London pop nearly $4 today to $77.62 a barrel, the highest seen since August 30th. As tensions build in the wake of Iran's missile attack on Israel this week, oil traders have become increasingly concerned about the potential disruption to the flow of crude oil in the Middle East. I will discuss all of these matters and what's happening today with the oil analyst John Kilduff from Again Capital, also CNBC contributor, also longtime contributor to this program. But first, on your money, the markets, the economy, and the whole works now. Joining us live, Brian Perry, Chief Investment Strategist and Portfolio Manager at Mint Asset Management at mintassetmanagement.com. He's also the author of the 25% Cash Machine. Brian, thank you very much for taking the call here this afternoon.
Well, it is a busy week here, Frank, and getting through this week with all the events around the world here and the fluid situation here at the port really does undo some of the real headwinds here, which we faced just in this week alone here. This port strike negotiation that's taking place right now is going to allow for, I believe, a 52% wage increase over the next 6 years, and so, but there's a 90-day cooling off period here, what they're just calling an extension, and that's really to deal with the larger issue at work here, and that's the automation issue. The union workers, the ILA, basically wants a complete ban on automation for gates, cranes, and what are called container moving trucks. And this is really kind of a non-starter because a lot of this has been tried before in other things like the auto industry, the coal industry, the rail industry, and you really can't bet against the march of technology. Okay, and this is really something that it's got to be managed well here, and there's a whole history going a pushback against automation going all the way back even to the port, the West Coast ports back in 1960, when everything was loaded by hand, and then therefore, but they were able to negotiate pay increases and job security arrangements, which basically allowed for longer times for transitions to take place and the retraining of personnel. And I think this is really what's going to take place here. Everybody recognizes the situation. You have this, this movement toward AI, and it's going to be managing all the conveyors and the forklifts and the cranes and the docking, And really, what you do eliminate in the process is a whole host of overhead for these shipping companies that, you don't have a number of things like, paid overtime. You don't have workers' comp. You don't have vacation time off, sick leave, family health insurance, disability insurance, pensions, matching 401ks, and you don't have strikes. So this is where the dock workers, their average pay is around $81,000 a year. Over time, they can make about $200,000 a year, which is solid pay, but it's very dangerous work. And so it's a real split. The wages part is something that could be worked out. I think what they're going to really run into over the next 90 days is how to deal with the business of innovation here, and how to protect workers in the business of, can they get retrained and become different kinds of workers, skilled workers, which they don't have to lose their jobs. But this all happened with the Kaiser Permanente strike, and they went from paper to digital. It went to Hollywood last year, which you well know. The script writers were wondering if AI was going to take over all the copywriting in that business. It certainly happened, in the auto strike here last year as well, which you had, the business of making batteries, for EVs, and then how that was going to work out. So, and although the UAW and Hollywood strikes did express job security over AI, it was more about how do we transition people, because Goldman Sachs wrote a report this year that said that globally there could be 300 million jobs eliminated by AI. And it's going to be the warehouse jobs and the freight jobs and logistics and a number of things. Like, it only takes one person to run a McDonald's apparently in some of these places in Japan. So it's all coming, and you can't fight the tape when it comes to technology. It's just going to happen because corporations are going to put it to use. But the
excellent analysis as always. We're on there live with Brian Perry,
Right.
Chief Investment Strategist at Portfolio Manager at Mint Asset Management, mintassetmanagement.com. The breaking news, and there were a flurry of reports on how this thing went here, but apparently the latest report is that the move today ends the strike that had snarled East Coast and Gulf Coast ports since the beginning of the week and threatened U.S. supplies of fruits, automobiles, and other goods. The major union for the dock workers and the U.S. Maritime Alliance agreeing to a tentative deal on wages and have extended their existing contract through January 15th to provide time to negotiate a new contract. And we're going to be getting the latest later this hour from Peter Tershwell from the Journal of Commerce, who's right on the front line of all this as well. Excuse me. So let me ask you this. We're on the air live with Brian Perry. You mentioned the job situation being impacted by AI, and certainly looked as if this was the strike was going to impact the job picture as well through for some time here. But we got the jobs report coming out tomorrow. The Fed will be watching it. Give us your reaction to the market activity today, and what might we expect tomorrow?
Well, the ADP numbers and jobs claims numbers are looking pretty good, if we can trust those numbers, Frank. We've had some major revisions here only recently, and it's you got to take it with a grain of salt here on the surface. The market loves to trade on headlines, and the market has some good tailwinds here. It's even bond yields have backed up here because Jerome Powell last week talked about how we're looking maybe for a quarter point, and the market was looking for more. So you had a little bit of backup in yields here. You've had we're coming into the third quarter earnings season here, which starts in earnest here in about 10 days, and with the big banks coming through here. So normally the front end of October is kind of bumpy, but the back end of October, which tends to highlight the earnings season, is best, and that really kind of starts leading off the market into the fourth quarter, which is typically the fourth and the first quarter, the two strongest quarters of the year. So jobs are looking. It's a very important report because it's going to kind of move the needle on the Fed Watch tool to determine is the Fed really going to have to cut another half point, or are we just going to go a quarter and a quarter? One way or the other, it looks like the dot plot is definitely looking for a lower interest rate. The bond market's already there, so the Fed is trying to just catch up with the bond market. And I think it's just, the market is looking for reasons to trade higher as opposed to sell off, and that's really the larger narrative at work here.
Jobless claims did rise ahead of the jobs report tomorrow to 225, I believe. Most analysts were expecting 220, and the ADP report came in with the hiring at 143,000. So what do you think is going to happen tomorrow, Brian, with the jobs report and the Fed's reaction and future rate cuts here on the table?
Well, I mean, the market here is looking for job and non-farm payrolls to rise by really about 135,000. That's not a lot, okay? And so that's for September, so that could be a miss. It's just hard to say. You got Amazon today talking like they're going to hire 250,000 people, for seasonal workers here, so just for the holiday season. And with the strike over, then everything's going to be able to make it on time, for the holiday season. So it's interesting to see how this is happening. But you still have hourly wages are expected to rise by 0.3% for the month. So you still have wage increases, making their way across the board here, and then the unemployment rate's expected to be somewhere around 4.3. So it's all looking backward, which is September. And I think really more importantly here, going forward, Frank, is what companies say during their earnings calls here is to pose their hiring plans or their layoff plans, based on either demand. Consumer is definitely looking like over $1 trillion in credit card out there. It's just, it looks like it's pretty stretched here from a spending standpoint, but this economy is very resilient, and the job market has it has a lot to do with it right now. But when we see these revisions, it does give you pause that tomorrow's numbers should be taken, with not too seriously, but enough that there's gonna be some revisions to it, next month.
All right. On the job front, we did see CVS, the drugstore chain, planning to lay off nearly 3,000 people, by the way. Paramount Global here in Hollywood and back east, laying off quite a few people, too, as well. So nervous time in a lot of places. And interesting, in the healthcare space, we see Humana has been under pressure lately, bringing its losses to, about 24% this week. What's going on in the healthcare sector, specifically with Humana and some of the other names now?
Well, I guess their Medicare plans didn't rate out very well here. So when they don't rate as high, they can't charge as much, and so they're taking like a massive hit. It's like a 24% hit, to the bottom line, and that's just part and parcel to the fact that Medicare and Medicaid are reimbursing a smaller percentage of what it's costing to deliver health care. And obviously these systems are getting stretched, and they're getting obviously they're getting overheated in a number of areas here where procedures are taking longer to get, and just trying to find a good doctor. Who a lot of them have closed their practices. So you have a lot of stress in the healthcare business, Frank, and you also have a lot of people that don't pay insurance, and that's putting a lot of stress on small business. So I think that there comes an inflection point that was part of the debate the other night, and it's going to involve more than just one solution. It's going to be many solutions to try to get this right. But one thing we do know is that the insurance companies are flexed, and their earnings are going to be under pressure. And that's in a void sector, whether it's United Healthcare or Humana or Aetna, the other ones there, because you just don't know what the headline risk is there, and it looks like it's bearish.
They're live with investment expert Brian Perry. At this point, Brian, with the market still at near an all-time high here, gold also near its all-time high, by the way. Any specific places where we are putting money now and/or taking it off the table?
Well, just yesterday, Jensen, Wang gave a very bullish outlook here for NVIDIA here, talking about the demand for Blackwell is, quote, insane. Everybody wants to be first, and everybody wants as much as they can get. And so NVIDIA, found its legs here and was up nicely today. So there continues to be a strong trend there for the whole AI trade. And there's just it continues to prove the naysayers wrong. The billions of dollars that are getting spent here for infrastructure and for data centers and for applications and now for machine learning and all these things, exactly what the longshoremen are scared of. Is this productivity trend that we're on here, which is going to make companies super efficient. So I'm still, long NVIDIA here. I think, there's another company coming out called Cerebras, which filed for their IPO today. And they claim they have an AI-specific chipset that is 20 times more powerful than what NVIDIA has on the market today. And they've already got a lot of, interesting customers there, whether it's, the Livermore Labs and GlaxoSmithKline and some big drug companies here in the Mayo Clinic and things like that. So they're another California superstar company that's about to go public here, something that people should really keep an eye on. And it's okay to own NVIDIA, but, it's another one to get in on here if they do come public here in the near term. Certainly, you look at, who's going to benefit most here from lower interest rates here? And those are the big private equity guys here. Blackstone has pulled back. BX. I really like that story here on a pullback here. With the hurricanes that took place here and just devastated Florida, Georgia, North Carolina especially, and in and around those areas there. Take a look at Construction Partners. The symbol is ROAD, ROAD, and their biggest clients are the states, the state governments, to come back in and repair roads and waterways and bridges and all kinds of things that got just devastated in this hurricane. They're going to write a lot of business there, and the symbol is ROAD, ROAD. I also like Berkshire Hathaway here. It's been pulling back quite a bit here off its highs. It was 480. Today it's 450. Right back here to the 50-day moving average. And lastly, for some people looking for another tech trade here, look at Marvell Technology, MRVL. They're a big player in supplying a number of chipsets and stack type equipment here to the data warehouse business here, and the stock is getting a lot of love from the analyst community there that I think is going to take the stock higher. It's currently trading around 70. Average price targets are going up, between 90 and 95. Coming off, Nike, they pulled guidance going forward with this new CEO. You just can't tell. We've been talking this a couple of weeks here, with the On and Adidas and Hoka and these other brands are just really taking market share here. So take a look at Nike as a one to avoid. And on a short, the China trade's just been ballistic. It's been straight up. And so PDD is a company that was Temu, and that's just, gone vertical. So I think it's okay to take, if you have these stocks, take a profit. If you don't have these stocks, I think they make a decent short just for a short-term trade.
All right, what about gold and silver here?
It's all good. I mean, you have there's no discussion of trying to balance the budget by either candidate here, and certainly Europe is doing the same thing with rates coming down and more money that is being printed every day by central banks. It just seems as if you still have downward pressure on fiat currencies here, and gold is pulling back just ever so slightly here, but it's in a breakout pattern, as is silver. So I'm looking at you can look at the GDX here, which is the VanEck Gold Miners ETF, and I own that for my clients. Trading at 40, just pulled back from 42, so that's a buy on the pullback. And SLV is your number one silver index ETF trade there. That's held its highs, and that looks so. Both these beautiful patterns here, Frank. It doesn't get better than what you're seeing here from a technical standpoint, and it's okay to have maybe a 10% exposure here to the gold silver market here, and then maybe also sprinkle some cryptocurrencies in there.
And what about crypto? Let's see. We have Bitcoin hovering just below 61K here. Briefly on cryptos, Brian, what are you seeing there?
Yeah, that pulled back here off their most recent. Well, it's really just got up to what we got up to about 61.5, 60, not even 62,000. So a minor pullback here. But today, PayPal after the close reported that they just completed their very first business transaction using its stablecoin currency, which is pegged to the U.S. dollar, demonstrating its use in commercial transactions here. So this is big news because now you have a major, a transaction company here starting to employ and deploy cryptocurrency in the form of stablecoin, which is the most, it is pegged to the dollar, so it doesn't move around a lot, but it allows you to do transactions globally without having to do foreign currency exchange. This is another phase of how, there's the utility of narrative that goes into the Bitcoin cryptocurrency story and its use case. And this is a brand new use case that's just come out after the close. I think it's a very bullish catalyst for the whole crypto market here going forward.
Thanks for highlighting that, Brian. Excellent as always. Appreciate it. Brian Perry, Chief Investment Strategist and Portfolio Manager at Mint Asset Management at mintassetmanagement.com. He's also the author of the 25% Cash Machine. Brian, thank you very much for taking the call today.
Always fun, Frank. Thanks so much.
Terrific. Thank you very much. And right after the freeways now on 790 KABC. Friends, did you know for more than 10,000 years, gold has been the greatest store of value and considered a safe haven asset to preserve your wealth? Well, now with the U.S. debt at more than $35 trillion and climbing, not to mention the Biden administration getting us involved in costly wars, developing the digital dollar central bank, digital currency, and inflation spiraling, it's more critical now than ever before to safeguard your assets, like your cash savings and retirement accounts, with physical gold. Opening a gold IRA is one of the best ways to secure your wealth and create a stable financial future for you and your family. Stop worrying about your retirement and the market and cash savings in the bank. Feel confident, prepared, and in control with real physical gold and silver. Give Joe Morgan a call at 1-800-753-8534 today, and he'll be happy to answer any questions you have. Again, that's 1-800-753-8534, or go to UnitedGoldGroup.com. Mottek On Money continues in 790 KABC, recapping one of our top stories. The union for 45,000 U.S. dock workers back east and along the Gulf Coast agreeing to suspend their strike until January 15th to provide time to negotiate a new contract. Looks like they've extended their existing contract for the time being. We'll get the details on that coming up here shortly and talk about it with Peter Tershwell with the Journal of Commerce. He'll be joining me live later this hour. Oil prices spiking today with the upheaval in the Middle East. We'll talk about that shortly with John Kilduff, oil industry analyst, and again, Capital and CNBC contributor. The Dow down 185 points today. The S&P 500 down 10. NASDAQ down 7. This ahead of the big jobs report that will be coming out first thing tomorrow morning. The ADP report came in with hiring 143,000 today. And looks like jobless claims came in at 225,000. Taking a look at the yield on the 10-year note, which impacts the fixed-rate mortgage rates out there. The highest in 5 weeks again all of a sudden. The yield on the 10-year is at 3.85%. Taking a look at the cryptos now, we see a Bitcoin down about 300 at 60,742. Ethereum up 7 at 2,349. And Doge at the moment at 11 cents. NVIDIA, the Magnificent One, getting a pop today at $4 at 122 and change. And now the latest news here in 790 KABC. Mottek On Money continues in 790 KABC. Tensions running high in the Middle East following Iran's missile attack on Israel this week as the Jewish New Year holiday Rosh Hashanah begins and the one-year anniversary of the terror attack on Israel by Hamas approaches on October 7th. A rise in oil prices intensified today after President Biden suggested that the U.S. is considering whether to support an Israeli strike on Iranian oil facilities, a move that could dramatically push gas prices higher just weeks before the presidential election. We did see a big jump in the price of crude oil today. In fact, the biggest one-day gain since the early stages of the Israel war on Hamas nearly a full year ago following the terror attack by Hamas on Israel on October 7th last year. Joining us live now, following all these developments closely, is oil industry analyst John Kilduff at Again Capital, also CNBC contributor and longtime contributor to this program. John, thank you very much for taking the call on this critical time here. Give us your reaction to this latest news here, first of all.
Oh, it's very nervous times and very serious times, Frank. It's pretty clear at this point that the Israelis will, in fact, make some kind of retaliatory strike against Iran. I will say, having watched the tape many times over and over again today of what President Biden was saying or trying to communicate, I'm chalking it up to something of a gaffe more than a sort of a signal that Iran's oil infrastructure will get hit. Although, as we've been analyzing it throughout the day, there is a potential where you could see Iranian refineries get hit because that would be more of a problem, obviously, in country rather than upsetting the balance of the world's oil supply. And that's what's hanging in the balance here, among other things, obviously. And that's what we're watching for. Just tonight, there's another slew of Israeli attacks in Lebanon. Apparently, another Hezbollah leader has been targeted, and we're waiting to see what the outcome of that is. I will say this, Frank. What's been laid bare here to me is that I'm not sure what Iran really has in its arsenal. So this is the second time in a row now that they've fired a volley of missiles towards Israel, and they all were pretty much shot down or done minimal damage, thankfully. Where this goes from here is going to be more strikes, more tumult for the markets generally in the region. But again, it's the tough call here in trying to analyze this from where I sit. Is do we go to the next level? And I'm not sure that's going to happen.
On there live with oil industry analyst John Kilduff at Again Capital and CNBC contributor. And Israel's been enduring a barrage of thousands of rockets in recent years, really. And, of course, this attack by Iran directly on Israel is very, very significant. I know there's a lot of discussion now about possibly attacking the Karg Island export terminal in Iran. You probably know more about it than I do. If that happens, what impact would that have? And also, if Israel finally goes after Iran's nuclear program, what impact would that have?
Karg Island would be a big deal. Karg Island attack would result in triple-digit crude oil prices within an hour. And you would see prices at the pump over the next ensuing days spike, 20, 40, 50 cents a gallon at least. That would be the big problem. I've talked to you about this before, Frank. This isn't 20 years ago. We have other players involved here, in particular China, who is heavily dependent on Middle East oil, on Iranian oil. They buy it through subterfuge. There's a whole cottage industry out there of Iranians avoiding sanctions and putting oil on one tanker and in the middle of the night, in the dark of the night, and turning off transponders, putting it on another tanker so they can clean it up. But that oil represents, 3%, say, of global supplies, about 2 to 3 million barrels a day. So I don't see Karg Island getting attacked. I really don't. I also don't see the nuclear facilities getting attacked yet. I think right now, and it was a former IDF spokesman interview that I saw today and then read the transcript of, where I believe that what's going to happen next is that the Israelis will strike the bases where the missiles have been coming from in Iran. That'll be the next step, and it'll be measured, Frank. And that's what I keep counseling here in terms of the oil market and everything else. I believe it or not, I do believe that the Israelis are still going to try to be measured here for one last go-around before the next step. The next step is everything you just talked about. And that's what we all have to game out here in the markets. But I will tell you that I don't think the Iranians have the stomach to push it to the next level, nor do I think they necessarily have the wherewithal. This is a very weak military country. I think Iran's military promise has been greatly exaggerated. I fell for it myself personally over the years here now, and seeing what they are just completely unable to do in response to anything, to all the affronts to a major leader of Hamas being killed in Tehran itself. And they still haven't had the funeral for the Hezbollah leader, Nasrallah, who was killed over a week ago now. It just shows you the fear in the region of Israel by these parties who led us to believe that they were, great warriors and the like. So I would just continue to caution about anybody getting carried away about what might happen next. It's going to continue to be measured much more than you would expect.
On there live with oil analyst John Kilduff, and again, Capital, also CNBC contributor and longtime contributor to this program. And obviously we're watching developments around the world with Ukraine and Russia still at war. The Houthis situation there also backing up shipping and likely impacting oil shipments as well. John, in all this, where do you see the price of oil and gas, for that matter, go from here?
I think here in the very short term, Frank, we're going to continue to go higher. I think there's just an increasing security premium about what happens next. I would point out, though, that the Israelis attacked the Houthis pretty strenuously several days ago now, incredibly sort of cleaning up the region here. I will tell you, Frank, save for what's going on here with Iran, we'd be much lower. You might have seen, or everybody might have heard about the Saudis now getting annoyed with their OPEC plus partners, which include Iraq and Russia and some of the other members there. The Saudis are threatening to do what they did in 2020, right before the pandemic, which is flood the market with oil. Now, they didn't realize the pandemic was coming back then, but that was what caused negative oil prices. I remember speaking to you, I think that day or the day after that occurred. So we'd be much lower. We're going to go lower. The economic situation in the manufacturing sector in Europe and China are just so poor right now, in severe contraction, really, particularly in Europe, but China too. And even with all their stimulus efforts, they're doing those stimulus efforts in China because they have to. Their backs are against the wall there. So, all these things are leading us to a situation where the oil price, after this calms down, will go down precipitously.
All right. At this point, from an investment standpoint, where would you be placing your bets? Some people ahead of winter like to bet on natural gas, for example, going up, or There are these various vehicles betting on higher fuel prices or lower fuel prices, and of course you track the various oil names very, very closely. What are your thoughts about investing in the energy sector at this moment?
Well, I mean, today was a great day, a great example of why you should have the oil companies in your portfolio. They were all up big today. It's a hedge against these, geopolitical tumult that comes our way. Now, a lot of the bulk of the stock market was much lower, but you had NVIDIA and some of the other big players there, keeping the averages sort of aloft. But today was a day where if it wasn't for NVIDIA in particular, all your portfolio would have been down except for your energy stocks, which would have been up. And I keep talking about sticking with the producers, in particular, the natural gas and oil producers. So that, again, is Viper Energy is one I don't think I've mentioned necessarily in the past before, but that's another great one. Diamondback Energy, but also, I continue to be a big fan of ExxonMobil and now Chevron as they've completed the merger and takeover of Hess, which had a tremendous oil and gas portfolio that got picked up. So it's a place for your portfolio for days like this, but also because, as much as I talk about the price of oil going down, Frank, and even with the Saudis threatening what they're threatening potentially, you're still going to have oil prices no lower really than $50 or even $45 a barrel. These companies will do just fine. They're great dividend payers. They're steady as she goes. They might not be a high flyer like NVIDIA, but you can't have all NVIDIAs in your portfolio. You got to have companies like that we talk about here because and particularly natural gas, Frank. I know some folks like to play that straight up in some of the ETFs. Those prices are going much higher. The demand for liquefied natural gas in this country continues to grow. More pipelines are being built out. The one pipeline that just got put in service has had tremendous demand for it, and we're going to see more LNG exports coming. And that's going to put pressure on our domestic supplies, actually, and raise the prices to consumers here. That'll be an interesting reaction, I think, when people wake up to that fact. But for now, everybody's doing okay. Prices are relatively low. The industry's doing great, and we're helping to, ensure the energy security, once again, of Europe in particular and Asia to a lesser degree.
Terrific, John. Thank you very much for coming to the line. We'll keep the line open to you in the face of all that's happening around the world. Oil industry analyst John Kilduff at Again Capital, CNBC contributor, and we're very grateful to say longtime contributor to this program. John, thank you very much for joining us this afternoon.
Thank you, Frank. Be well.
Likewise, thank you very much. And out to the freeways now, 790 KBC. Mottek On Money continues here in 790 KBC. Breaking news this hour on the port strike back east and along the Gulf Coast. The union for the 45,000 U.S. dock workers have agreed to suspend their strike until January 15th to provide time to negotiate a new contract. Joining us live now, Peter Tershwell with the authoritative Journal of Commerce, vice president there, responsible for all the content of the publications, websites, and events, including the big Trans-Pacific Maritime Conference held in Long Beach every year. Peter, thank you very much for taking the call on this big story. What is the very latest there coming across your desk this afternoon?
Well, hi, Frank. A pleasure to be with you. What we learned just a short time ago was that the labor union that represents dock workers in every port from Maine to Texas, about 45,000 dock workers, and the management group, which is dominated by the big ocean carriers, that they reached an agreement on wages only and what that's going to do. So they do not have a final contract yet, Frank, but what they've done is the union has agreed to end the strike, so it's about a 4-day plus strike that they engaged in. And they both sides have given themselves until January 15th to sit at the table and knock out a final contract. Now, what's interesting about that is that there's still a lot of issues that have yet to be worked out. So I'm not necessarily predicting that they're going to go back on strike or that there's going to be further work stoppages here. I don't really have much of a sense of that yet. It's a little early, but there's still a lot of details to be worked out.
On there live with Peter Tershwell from the Journal of Commerce on this big story here this afternoon. It appears that the dock workers will get back to work. Is that expected to happen already tonight or by tomorrow, Peter?
Yeah, when the agreement came out, the dock workers said that the strike will end, so the strike is now over, and that means a sort of slow motion process will now be set into motion to reopen the ports after about 4.5 days or thereabouts of being closed.
All right. And, of course, all of this had threatened just before the holiday season the shipment of goods into the United States, as well as a shipment of essentials such as fruits and other food items, automobiles, and so forth. So it looks like consumers, can we all breathe a sigh of relief for the time being?
I think we can. I mean, the impact on the holiday season goods was always going to be somewhat muted. The reason being that the major retailers, consumer products companies that are bringing holiday goods into the country saw this strike coming a mile away. I mean, the Longshore Union on the East Coast has been threatening a strike since last November. It has been well known out in the media that this is a possibility. And if there's one thing that companies learned from COVID and all the extraordinary supply chain disruptions that occurred during that time, is that if they see a problem on the horizon, they are going to take remedial action. And that's exactly what they did. So the typical so-called peak season in import container shipping is usually July, August, September. This year it moved up by 2 months. So therefore, it was a very busy May and June of this year, especially at the ports of LA and Long Beach. By the way, where the growth of imports at LA and Long Beach was substantially higher this year than at ports on the Eastern Gulf Coast. And in part, that reflects the, number one, goods coming in earlier, number two, avoidance of East Coast, given the possibility of a strike, Frank.
And you're, of course, following things around the world. I understand you're coming to us from Singapore here at the moment, where an enormous number of ships are backed up there, right, because of disruptions related to what's happening in the Red Sea in the Middle East. Give us a quick update on what's happening there.
Well, correct, Frank. So Singapore is a big transshipment hub. So 95% of the containers that come in and out of Singapore just never leave the port. They get off one ship and then they get onto another ship. And Singapore, as well as some of the other regional transshipment ports out here in Asia, experienced very severe congestion earlier in the year. In part, the reason was that the transshipment hubs, the transshipment ports that are in the Middle East region, became almost unusable or much less convenient for the ocean carriers to use as a result of the diversions around the Red Sea. So as you
Peter, thank you very much. I wish we had more time, but we'll have to stop there and look forward to your updates. And thank you very much for coming to the line on the big news this afternoon. That is Peter Tershwell, Vice President at the Journal of Commerce. Stay tuned now for the 790 KBC News Blitz with Randy Wang, and I'll be back with more at 4 tomorrow afternoon right here on Mottek On Money on 790 KBC.
Every week, Michael Rosenbaum is getting deep with someone new on the Inside of You podcast. Actor James Marsters.
Are you somewhat content? Do you still stress a lot?
If anything, I feel guilty that I have it so good. If you make the decision to be an actor, the deal is poverty. I don't understand. How did I get here? You know? And the answer, how did I get here, is really one audition one day for Buffy the Vampire Slayer.
Inside of You with Michael Rosenbaum, wherever you listen.